Another thing that I think is interesting is the conversation of floating rates versus fixed rate debt. And floating rate debt has been painful to deal with over the last year almost, a little bit less than a year, because of the dramatic rise in interest rates. And it's easy to sit here today and look back and go, oh wow, well, we should have fixed our rate, and that's absolutely true. However, at the time of all these deals that got done in 2021 and early 2022, the forward curve was very flat, which means that the market, which is the smartest people in the world and the general consensus, was projecting for interest rates to stay low for at least 2 to 3 years. And that was in line with the Federal Reserve's guidance as well. They were essentially promising the market that they were going to keep rates low. Their position on inflation was that it was transitory. Somewhere along the lines, their script was completely flipped, and they changed their position on inflation, and they said, hey, inflation is no longer transitory. We are deeply concerned about inflation becoming entrenched, and we need to have a regime change as it relates to interest rates. And so they aggressively raised interest rates far and above what the market had projected, right, given the guidance and the general consensus. And that brings us to where we are today with the dramatic rise in interest rates. The good thing is that most people have interest rate caps in place on their floating rate debt, which means that they've already hit their ceiling on their debt service costs. However, they have to plan ahead. Owners with floating rate debt have to plan ahead to their interest rate cap repurchase. So if you have to buy a replacement cap, you have to factor in what is the cost of that cap going to be whenever my existing cap expires, which could be coming up in 6 months, it could be in a year, it could be in 2 years from now. But eventually that cap is going to expire, and you have to be prepared to purchase a replacement cap at the prevailing cost of that cap. And that could be very high, it could be a little bit lower. It depends on where interest rates are at that time, as well as where the futures market is for interest rates, which is driven by the forward curve, SOFR primarily when we're talking about floating rates. So right now, we're approaching the end of the tightening cycle, which means the Fed is approaching ending their rate hikes that they have planned. And from then on, we're going to be anticipating rate cuts, right? That's the natural cycle, rate hikes, rate cuts, and so on. And when you approach the end of the cycle for hikes, that's when caps are the most expensive, because the market projects rates to be continuing to go up and then flatten out and then eventually come down.